The market is always trending one way or another. We only need to know where exactly is it trending, and most would claim that this market right here is trending to the upside, because that's what you see if you just look at it. But the problem is that you skip important steps, and that's why I suggest when you enter a market, you analyze the directional bias of the price. If you're a frequent viewer of my channel, you've probably seen how I mark the directional bias with these arrows and lines. This simple directional analysis is a lot more important than it looks, and so many people skip it. This quick analysis shows you the swing points the market has been forming, and without knowing the swing points, you can't understand the trend. For example, we see how these swing points had higher lows, and they also had higher highs. Those are swing points of an uptrend. Now, if we look at how it continued after this low, which was a higher low, we got an upside pullback that ended on a high. And from this high, the price fell down aggressively and broke below the previous higher low. So if we look at it, after this break of the low, now we can know with certainty that this high was a lower high, and the fact that it broke below the last low, that's a new lower low that just got formed. Now when the market reverses one of its swing points, in the case where the market was following an uptrend, so it had multiple higher lows, but then it reverses into a lower low. That first lower low is what marks the trend shift into a downtrend. But why a downtrend? Because lower lows are the swing points that are found on downtrends. And since we already have the first lower high here, that was only validated after we also formed the first lower low, the probabilities for now is that this market should follow a downtrend, which is what it's currently doing right now. Since from that lower low, we got an upside pullback that quickly rejected back down. And it's looking like it's about to push down into breaking the previous lower low, which would create another lower low. So basically, it's just printing the swing points of a downtrend. It's what it holds this market in a downtrend. Now, if you remember what I said in the beginning, where most traders just skip this analysis and would say that this is just a market that's going up, well now, with a proper analysis being done, we know that this market had two parts. The first part, where it was in an uptrend, and now the second part, where it's following a downtrend. The downtrend gives the opportunity for sell setups from supply or resistance levels. Those are created when the price is at a high and it impulses to the downside. We take the last candle that closed bullish before the market started pushing to the downside, and we can even see that the next time the price pulled to the upside, the next high, which was a lower high, it ended inside this level. So if we have rejections down from these zones, it makes sense to take advantage of them with sell setups from these levels. And so it repeats on the next ones as well, because from this pullback to the upside that formed the lower high, we see how soon after, on the next candle, it turned really bearish, pushing the price down with aggressive downside candles. So the last bullish candle before the downside impulse, that becomes another supply. And when the market pulled to the upside, yet again, the high ends on the supply. I'll take the drawings away for a bit so we clearly see that it did wick into the level, and right after that wick it's starting again to aggressively push down. The goal is to break below the last low. And when the last low breaks down, that validates that this was a lower high. That means that another supply zone was probably made from this high, since we got a pull to the upside, followed with an aggressive breakdown. The supply being the last bullish candle before the breakdown started. Now from this lower low that was just created, a lower low on downtrends should be followed with a lower high. Pretty much the same thing as it did earlier. That means that we should see some pullback to the upside from this low, and this pullback needs to end inside the supply. It needs to end there so it can form the lower high, and from that lower high the price can break to the downside, essentially holding the downtrend continuation. So if we expect a lower high, it practically makes sense to plan a sell short setup from this supply, with the stop loss above it, and take profit somewhere below the last low, targeting around a 2-to-3 ratio. We got the pullback to the upside, which hit into the supply. That means that it opened the sell setup. And soon after it hit, the next candle's quickly rejected down, and it breaks below the last low, closing the sell setup on the take profit target, and even going lower than that. Now starting fresh on another chart, again, remember the first step, doing the directional analysis so we can identify the swing points. This just makes it so much easier, and in the other way around, without this directional analysis, everything becomes a lot harder. It's that important, and still most will skip it. So what we're able to see now is that we have these constant lower highs, and also constant lower lows. The lower high is named specifically as a lower high, because that high must end below the last high. So that means that the market is not able to break above the last high, and this being a high, the pullback to the upside should not break above it, which we see that it didn't. Then from that pullback, the market started an aggressive bearish momentum, this breaking below the last low. Now when the low breaks, we know with certainty that this high is a lower high. And so if this is the new lower high, then if we are looking for trend continuation, the market should not break above this high the next time the market pushes to the upside, but instead it needs to end below this level, usually on a supply or resistance from the recent high. So we look at the last high, then we look at the last bullish candle before the market started to gain the bearish pressure, would be around this candle. We can already see how it's starting to pull back to the upside. Chances are that this pullback will keep going up until it at least hits the supply, and from here we can plan a sell setup and take the market into hopefully continuing the downtrend. The downtrend continues when the price breaks the last low, exactly like it has done before, where we can notice the downside breaks. So if we expect a lower high, we can plan a sell short setup from the supply. The stop loss should be placed above the supply, and in the best case, it should not be far away from the previous high. Because if it's not far away, it makes even more sense to have the stop loss slightly above the previous high, which should also be above the supply. Of course, there is a logic behind this placement. The logic is that if the market breaks above the supply, and also above the last high, which was a lower high, and it forms a higher high, then we are in for a potential reversal into an uptrend, and so an uptrend should reverse the swing points into higher highs, which it would be forming if we get the break. That should be combined and followed with a higher low. So later it can continue this swing point combination, which is basically what holds an uptrend. If this happens, because of this placement of the stop loss, we accept the smallest loss we can take, because the last thing you want is holding for a long time a setup that's not going in your way, but even worse, it's going more and more against you. And now the take profit has a similar logic. It's all based on the swing points. If this downtrend keeps holding, it should be forming a lower low, because that's just the swing point of the downtrend. So if we look for a lower low, that means that the previous low needs to break down. That translated into the chart would mean placing the take profit somewhere below the past low, and you know what ratio I usually suggest, around 2 to 3. In most cases, you won't need more than that. Even a 3 ratio is a lot. But that's slightly more rare to find that type of good setup that can be also sustained in the long run. Right now it's pulling back to the upside, hits into the supply, which means the sell setup has opened, rejects down from the supply. So far it's respecting it. Now all we need is for this bearish pressure to keep going for a few more candles, which eventually did and hit the take profit target. Since it has hit the take profit, that also means that it broke below the past low, creating another lower low. So it has held the swing point of a lower high that was then followed with a lower low. Now when the low breaks down, that validates that the last high was in fact a confirmed lower high, and if we expect downtrend continuation, then we expect the next high to not be able to break above this high, meaning that we are expecting an upcoming lower high that should be followed with a lower low. This is not even about predicting anything. It's about looking what worked before, which was just following the downtrend, and we just do it again and again until it stops working. Now if we have a lower low, the next swing point would be a lower high. The lower high is basically a pullback to the upside that can't break the past high, so it needs to end somewhere below it. And more specifically, many times it ends on a supply or resistance. So we identify that supply or resistance from the last high, being the last bullish candle before the downturn started to happen, should be around this candle. Now, similar as we already done before, we plan a sell setup from the supply, with the stop loss above the supply, and also above the last high. Take profit below the low, should target around a 1 to 2 ratio or 1 to 3, somewhere in between. It pulls into the supply, opens the sell setup, but this time it hits on the stop loss. Now this is where most would leave the charts and eat the loss. Maybe even get mad because of a losing setup, but this means nothing actually. And losing is completely normal. What you want is to lose as little as possible. So if it hits on the stop loss, that means that it broke the supply and it also broke above the last high. The last high was a lower high, and now since it broke above it, that's a new formation of a higher high. When the market was in a downtrend and then the market breaks above the last high forming a higher high, that higher high is what we call it as a trend change or market structure shift from a downtrend into a possible uptrend. On uptrends we have higher highs, which we already have the first one right here, and it's usually followed with a swing point of a higher low. That means that when the market pulls back down, That downside pullback should not be able to break below this low, but it needs to end somewhere above it. And of course, we can't know with certainty the exact point it will end, but now instead of using supply zones, we use demand zones. They will help in knowing with some approximation where the market might end its pullback. The demand is found on the last low, and more specifically, on the last candle that closed bearish right before the market turned into upside pressure. Now the market pulled down and hit the demand. Now we have two options. We can plan a buy setup straight from this demand and take the market into bullish continuation, basically expecting a break of the previous high into a higher high. The only problem with this approach is that we don't have a demand that is validated recently. What you can do is to use this demand from this time frame in confluence with the price action of a lower time frame. That means that when the price hits this demand, that we consider as a main demand, we zoom into a lower time frame. This is on the 5 minutes as an example. On this low time frame, we can see how when the price hits the demand from the higher time frame, it quickly bounces to the upside with quite aggressive bullish candles. We can consider the last bearish candle before the upside impulse as an internal demand taken from the low time frame. And instead of buying from the high time frame demand, we plan the buy setup from this lower time frame demand. You might ask why? Because if we check it out, we're buying at a higher price. Compared to if we would buy the demand from the high time frame, isn't it better to buy at a lower price? That question is not complete, because of course the entry level matters. But what also matters is the exit targets of the stop loss and take profit. By trading the internal demand, we have different exit levels. The stop loss is now placed below the internal demand instead of below the higher time frame demand, and we look for the take profit above the recent high. It begins to pull back to the downside, hits the internal demand, which opens the buy setup, and the very next candle is closing bullish, bouncing to the upside. It's retesting the demand, getting pretty close to the stop loss, but as long as the price is inside the demand, we're fine. Now finally it's pushing to the upside, and closes on the take profit by breaking above the last high. So when you're using this strategy of lowering down time frames so you can plan a scalp setup, that takes extra steps. Now you can also just swing the setup. You choose which approach you like the most, holding setups for hours and days, or just scalping them, getting in and out in a few minutes. On the swing approach, we come back the moment the market hits the high time frame demand. And as I said, we can just buy this demand. Now the stop loss is being placed below the last high time frame low, and the take profit above the last high time frame high. And it still works just as fine. It just continued the uptrend that it just started by forming again higher high swing points that are coupled with higher low swing points. Now keep in mind, this was just one simple concept that was taken into more and more complexity.